There is this incredibly tense moment in every major market rally where you just have to pause. You look at your portfolio and you ask yourself a really uncomfortable question.
Right. Like, are you looking at a genuine, unstoppable breakout?
Exactly. Or are you staring right into the jaws of a perfectly disguised value trap?
Yeah, that is the worst feeling.
It really is.
Yeah.
Because right now, we are looking at a stock that just ripped over 15% in 2 weeks. I mean, it's flashing strong buy signals across the board, generating just unbelievable amounts of free cash flow.
But, at the exact same time, it's got valuation metrics that suggest it might be dangerously overextended.
All right. And to top it all off, over half the retail sentiment online is heavily betting against it. So which is it? The smart money breakout or the retail trap? Welcome to today's deep dive.
It's going to be a good one.
Definitely. But hey, before we jump into the numbers, make sure you like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave us a comment with your feedback. We read them all, and we really want to hear from you.
We actually do read them. Your comments literally dictate the models we run and help us shape, where we take these deep dives next.
For sure. So for today's mission, we're digging into our stack of financial sources to unpack the Brazilian banking juggernaut, Itaú Unibanco holding SA, ticker symbol ITUB.
A massive player.
Huge. And just for context, today's date is April 14th, 2026. The stock is currently trading at $9.17 after just an absolute tear. Like I said, a massive 15.08% run over just the past 14 days.
Which is aggressive for a bank of this size.
Very. But before we get into the weeds of, why that is happening, I need to explicitly state that this conversation is a natural, objective debate based strictly on the provided financial data. We're looking at the math, the filings, the macroeconomic landscape.
Right. None of this is financial advice.
Exactly. No financial advice here. We're just trying to figure out the underlying mechanics of this price action.
And when you're dealing with a financial institution of this specific magnitude, the mechanics are incredibly complex.
They really are.
Yeah.
Which is exactly why I want to start with the foundation. Because you can't really assess a 15% spike without knowing what the actual engine of the company looks like.
You have to look at the numbers.
Right. And the 2025 annual income statement is, frankly, it's staggering. We're looking at total revenue of 165.24 billion raise.
Wow.
Yeah. Net income sitting at 44.86 billion raise, which shakes out to a basic EPS of $4.05. I look at those numbers, and the first thing that jumps out to me is the sheer conversion rate.
Yeah, they aren't just generating top-line volume.
No, they are defending an incredibly thick net interest margin.
If we connect this to the bigger picture, you have to understand the structural reality of the Brazilian banking sector. It is a highly concentrated oligopoly.
Right, there's just a few big players.
Exactly. You have a handful of incumbent banks that basically control the vast majority of the credit market. And because of that concentration, Itaú has immense pricing power.
So they can dictate the terms.
Pretty much. When they take in deposits and lend that capital back out, the spread they capture is structurally wider than what you typically see with, say, North American or European banks.
That makes sense.
So that 44.86 billion raise in the net income, that's the direct result of that pricing power. It's just an incredibly efficient machine at extracting retained wealth.
Okay, let's unpack this, because the efficiency is obvious on the income statement. But then you look at the December 2025 balance sheet, and the scale gets almost hard to comprehend.
It's massive.
It is. I mean, we are talking about total assets of 3.08 trillion raise, total liabilities of 2.86 trillion raise. That leaves stockholders' equity at 204.40 billion raise.
Right.
And the kicker is the free cash flow. 128.23 billion raise in free cash flow. But, okay, here's my pushback.
Let's hear it.
I look at this like maneuvering a colossal cargo ship, right? It's impressive, but hard to pivot. If the engine is that efficient and they are sitting on over 128 billion in free cash flow, why is the stock sitting here at $9.17?
That's the big question.
Right. The 52-week high is $9.60. The low was $5.19. If they're an oligopoly, basically printing cash, why are we hovering below the 52-week high instead of absolutely smashing through it and setting new records?
Well, it's because of the macroeconomic gravity attached to a $3 trillion real balance sheet. You have to remember that in banking, assets are predominantly loans.
Okay.
So that 3.08 trillion isn't like cash sitting in a giant vault.
Yeah.
It's a massive living ledger of corporate debt, consumer credit, mortgages. It is intrinsically tied to the entire Brazilian economy.
So they're exposed to everything.
Everything. So while the free cash flow is undeniable, institutional investors are constantly pricing in forward-looking risk. They're asking, what happens if inflation spikes? What happens if unemployment ticks up?
Ah, so it's a risk premium.
Exactly.
Yeah.
The market knows Itaú generates cash today, but the hesitation, that ceiling keeping it below $9.60, is the risk premium associated with holding an emerging market loan book of that sheer size.
So the cash generation is the engine. But the macroeconomic risk is the headwind keeping the plane from climbing higher.
That's a great way to put it.
But, that macrogravity makes the current price action even weirder. If that risk is a constant, why is the stock suddenly spiking 15% right now? Let's look at the tape, because the technicals are painting a wildly aggressive picture that seems to be ignoring that macro risk entirely.
Yeah, the tape is heavily bullish right now. The momentum has completely decoupled from the broader macro hesitation you just mentioned.
It really has. I mean, ITUB is trading aggressively above its 200-day simple moving average. The battle lines are clearly drawn. We have immediate resistance sitting right above us at $9.21.
With a major, much heavier algorithmic barrier at $9.57.
Right. And on the downside, immediate support is at $9.10. If that breaks, there's a much stronger structural floor down at $8.29.
But it's the indicators that are driving this 15% run.
Yeah. The MACD just issued a definitive buy crossover on the 3-month chart. The RSI is trending upward with plenty of room to run, but I think the most important piece of the puzzle is the volume. We aren't just drifting up. The volume is rising right alongside the price.
Right, which tells you this isn't just retail speculation. I mean, price movement without volume is just noise.
Exact.
But when you see the MACD crossover trigger and the RSI climbing alongside rising volume, you are looking at institutional algorithmic buying.
The big boys.
The big boys. Quantitative funds have parameters built around the 200-day moving average. Once a stock of this market cap breaks above that line and shows volume confirmation, these algorithms are mechanically forced to allocate capital. They just buy the momentum.
It's like a speeding car approaching a brick wall, though. Will it break through or crash? Because here is where we hit a massive contradiction.
The sentiment.
Yes, we've got algorithmic momentum ripping the stock upward, heading straight for that 9.21 resistance line. But if you look at the social data, 54% of social mentions right now lean cautiously bearish.
More than half.
More than half the retail sentiment is betting against this breakout. If you're watching the tape, you're essentially seeing human retail traders fighting institutional machines right at that resistance line. Why is retail so convinced this is going to fail?
It's a phenomenon called retail vertigo.
Retail vertigo?
Yeah, retail traders and institutional algorithms process momentum completely differently. When everyday traders see a large cap bank run up 15% in 2 weeks, the immediate human instinct is mean reversion.
They think it has to come back down.
Right. They think, oh, it went up too fast, I missed the entry. It mathematically has to pull back. That's where that 54% bearish sentiment originates.
So they're fighting the trend because they feel late to the party.
Precisely. The algorithms, on the other hand, don't feel vertigo. They just follow the volume and the liquidity.
Must be nice to be a robot.
Seriously. However, that retail caution isn't entirely irrational here. I mean, they are looking at the chart and they see that $9.57 major resistance level looming.
Right.
That isn't just a line on a chart. That 9.57 level represents a historical algorithmic tripwire. It's a price point where massive institutional sell orders are mathematically programmed to trigger to lock in profits. So retail traders are terrified of buying at 9.100, watching the stock hit 9.57, and getting crushed by a wave of automated selling.
Okay, so if retail is sweating bullets, who is actually winning this fight? Let's follow the capital and see what the pros are doing. Let's look at the analyst ratings, the institutional flows, and the insider transactions, because this is where the narrative completely fractures.
The divergence in the professional data right now is absolutely fascinating.
That's putting it mildly. Here's where it gets really interesting. Let's start with the analysts. The current consensus rating is a moderate buy. We've got 6 buys, 1 hold, and 1 sell.
Okay.
That sounds perfectly aligned with the breakout, right? But then you look at their actual price targets. The average price target from these exact same analysts is $8.33.
Right.
We are currently trading at $9.17. That average target mathematically implies you will lose roughly 9% of your capital if you buy the stock today. Even their high estimate is only $9.40, which we are essentially already touching. So make that make sense for me. How can Wall Street slap a moderate buy label on a stock while their own models predict a 9% downside?
I know it looks completely hypocritical, but it comes down to the mechanics of how sell-side research is actually produced.
Okay, how so?
Analysts don't update their discounted cash flow models every time a stock has a good 2 weeks. Those models are really rigid. They rely on quarterly data, projected loan growth, and fixed discount rates.
So they're slow.
Exactly. When a stock violently spikes 15% in 14 days, the tape simply outruns the spreadsheets. The moderate buy rating is their qualitative view, like they love the $44 billion in net income.
Right.
But that 8.33 price target, that's a quantitative relic. It reflects where their models thought the stock should be a month ago before the algorithmic buying took over.
Wow. They are essentially analyzing the wake of the boat, not where the boat is actually heading.
That's a perfect analogy. The price action blew past their assumptions, and it will take until the next earnings cycle for them to revise those buckets upward.
Fair enough. But, the contradictions get even sharper when we look at who is actually moving real money. On the institutional side, we have North Cape Capital.
Yeah, big players.
They just increased their position in ITUB by an aggressive 31.7% in the most recent quarter.
That is massive.
It's a massive reallocation of capital for a fund of that size. They're heavily convicted. But meanwhile, inside the company, and this is crazy, Andre Luz Teixeira Rodriguez, who is the retail business officer at Itaú, executed a sale of $1.61 million worth of shares on April 8.
That is a glaring optic for the retail crowd.
Right. So I have to challenge the institutional thesis here. North Cape is buying from the top down, but Rodriguez manages the actual retail business. He sees the daily credit card defaults. He sees the auto loan delinquencies.
He's got boots on the ground.
Exactly. If North Cape's models are so bulletproof, why is the executive managing the actual consumer loan book, dumping $1.6 million on the open market right in the middle of a 15% rally? Are we looking at a genuine conflict of insight here? Does the insider see a default wave coming that the algorithms are blind to?
It's the ultimate Wall Street Rorschach test, really.
How do you mean?
Well, when retail traders see a C-suite executive sell $1.6 million in stock, they immediately assume the insider knows the ship is taking on water. But you have to strip the emotion out and look at the reality of corporate compensation structures.
Okay.
Executives at that level receive the vast majority of their compensation in restricted stock units. When those units vest, they trigger massive immediate tax liabilities.
The tax man comes calm.
Always. It is incredibly common for executives to have automated, scheduled sell orders programmed months in advance strictly to cover those tax bills. Or, honestly, more simply, they're diversifying.
Right. Don't keep all your eggs in one basket.
Exactly. If your salary, your bonus, and 90% of your net worth are all tied to one Brazilian bank, fiduciary logic dictates you take some chips off the table when the stock spikes 15%.
So it's personal portfolio management, not a referendum on the company's solvency.
Most likely, yes. And, you have to weigh that 1.6 million insider sale against North Cape, increasing their stake by 31.7%.
True.
Institutional funds do not arbitrarily increase their exposure by a third on a whim. That signals deep multi-year conviction in Itaú's ability to compound equity. They aren't looking at the 9.17 price tag today. They're modeling out the cash flow for 2028.
And that tension between North Cape backing up the truck, the insider offloading shares, and the lagging analyst targets, that brings us right to the absolute core of this entire deep dive.
The valuation debate.
Yes. Is ITUB properly valued right now? Because if you're listening and you're holding this stock or thinking about buying this breakout, this is the debate that matters. Are we looking at an undervalued gem or a classic retail value trap?
This is where we have to dig into the actual valuation multiples because they are telling two very different stories.
Let's start with the bull case. The trailing PE, the price-to-earnings ratio, is sitting at 11.47x. Now, if you benchmark that 11.47 against global banking peers, especially considering Itaú's record asset quality and that $44 billion in net income we talked about, it is incredibly easy to argue that the stock's undervalued. It looks cheap.
Yeah, an 11.47 multiple for a dominant market-leading financial institution with that kind of margin is objectively reasonable.
But, and this is a huge but, and you flip the page and look at the price-to-book ratio. The 2026 price-to-book estimate is sitting at nearly 2.0x.
Yeah, that's high.
High. If you hold ITB, that 2.0x book value compared to its peers is exactly what should be keeping you up at night. The historical average for major Brazilian incumbent banks is right around 1.0x.
And that metric is the entire foundation of the bear argument right there.
Because it's essentially paying a 100% premium. Let's talk about why that matters so much for a bank. If you're valuing a tech company, book value is basically useless.
Right. Their value is in software and IP.
Exactly. But a bank's book value is literally the mathematical net worth of its tangible assets. Its loans, its cash, its securities. So if you buy ITUB at a 2.0 PB, you're paying double the actual sticker price of those assets. It's like paying double the sticker price for a house just because it's in a nice neighborhood.
That's exactly what it is.
Why would anyone pay a 100% premium for a loan book, especially when the macroeconomic environment is flashing warning signs? We have rising oil prices. We have tensions in the Middle East weighing on all emerging market equities. And crucially, we have the Central Bank of Brazil, the BCB, facing inflationary pressure that might force them to deviate from their expected interest rate cuts. So how does that macro risk actually hit the stock?
What's fascinating here is how directly that macro narrative attacks that 2.0x premium. The transmission mechanism is very straightforward.
Walk me through it.
So, if global oil prices spike, that drives up inflation in Brazil. If inflation runs hot, the Central Bank of Brazil has to halt their planned cuts to the Selic, their benchmark interest rate.
Right.
If rates stay elevated, floating rate consumer loans become more expensive for everyday Brazilians. That inevitably leads to a spike in non-performing loans or defaults.
The dominoes start falling.
Exactly. If Itaú's loan book starts deteriorating because consumers can't pay those higher rates, the market will instantly strip away that 2.0x price-to-book premium. The stock would re-rate back down toward the 1.0x industry average.
Wow.
And that is the literal definition of the value trap you mentioned at the start of the show. You buy the momentum at 9.17, the macro environment shifts, the multiple compresses, and you are trapped holding the bag.
Right. You paid double for a house right before the neighborhood flooded.
Exactly. However, as objective analysts, we have to flip the coin. Why is North Cape Capital willing to pay that 2.0x premium? Why do the algorithmic buyers keep pushing the volume?
There has to be a reason.
There is. It all comes down to one metric, ROE, return on equity. Itaú consistently delivers the highest ROE and efficiency ratios among all its Latin American peers.
Okay, but explain how that justifies paying double the book value.
Think of it like this. If a bank has a price to book of 1.0x, they are essentially just treading water, maintaining the value of their assets. But Itaú isn't just sitting on that 204 billion raise in equity. They are compounding it at an extraordinary rate.
Ah, so that's what they do with the money.
Right. Their efficiency ratio, the cost required to generate $1 of revenue, is remarkably low. Furthermore, they are aggressively returning that massive free cash flow back to shareholders in dividends and buybacks.
Okay, I see.
So the bull thesis is that you aren't paying a 100% premium for a static loan book. You are paying a premium for the premier management team in Latin America. A bank that delivers record asset quality and market-leading ROE simply deserves to trade at 2.0x.
It's not a trap, it's just the cost of admission.
Exactly. It is the fair market price for best-in-class performance, and the bulls would say the bears betting on macro volatility are simply missing the structural strength of that balance sheet.
So it really is a tug of war. The bears see a 2.0 multiple that is highly vulnerable to inflation and interest rate shocks, and the bulls see an unstoppable compounding machine that justifies the premium.
Which brings us to the horizon. We've got listeners trying to map out their strategies here, summarize the probability landscape for us, like what are we looking at in the short term versus the long term?
Well, in the short term, the statistical data suggests a 90% probability that the stock will trade within a channel between $8 and $9.82 over the next 3 months.
So pretty tightly range-bound?
Yeah, it's heavily coiled.
Yeah.
The key trigger is that $9.21 immediate resistance. If the institutional volume can push it cleanly through 9.21 and then take out the recent session high of 9.22, the momentum algorithms will likely double down.
Pushing it toward the upper end of that channel, right? Testing that 9.57 level we talked about.
And if we stretch the timeline out, what is the long-term outlook?
Long-term, the institutional outlook remains incredibly bullish, entirely driven by digital transformation. Itaú is radically streamlining its legacy branch operations and migrating services online.
Cutting costs.
Massively. If they can execute on those efficiency gains without sacrificing market share, models suggest they could push their return on equity above 25% by late 2026.
Wow, 20%.
Yeah. If an incumbent bank of this sheer size hits a 25% ROE, the debate over that 2.0x price-to-book ratio ends immediately. It becomes entirely justified, and the stock re-rates significantly higher.
And the interesting thing is we don't even have to wait until late 2026 for the narrative to shift because there are two massive catalysts sitting right in front of us. First, the board of directors just approved a staggering $3.85 billion real interest on capital payout.
Which serves a critical function on the chart.
Really? How so?
Well, a massive shareholder payout like that acts as a structural floor. It gives institutional investors a tangible yield, which reinforces that 9.1 support level. It literally incentivizes them to hold through the volatility.
Right, they get paid to wait. And second, we have the official earnings date looming right around the corner on May 5, 2026.
Which is the ultimate moment of truth. May 5th is the day those lagging analyst spreadsheets finally have to face the reality of the tape.
So what does this all mean? We've looked at an absolute behemoth of a 3.08 trillion real balance sheet. We've seen heavily bullish algorithmic momentum slamming into terrified retail sentiment at the 9.21 resistance line.
Quite the collision.
Yeah. We've untangled the lagging analyst targets, the massive institutional buying by North Cape, and the insider tax harvesting. And ultimately, it all boils down to that fundamental tug of war.
Yeah.
The undeniable power of a market-leading return on equity versus the vulnerability of a 2.0x price-to-book premium. ITB is undeniably a financial juggernaut throwing off massive amounts of cash.
Undeniable.
But it is wrestling with that premium valuation, trading dangerously near the top of its 52-week range, all while global macroeconomic risks like inflation and shifting central bank policies threaten the broader emerging market landscape.
It really is the ultimate test of an investor's conviction. Every single data point is balanced on a knife's edge between a structural multi-year breakout and a punishing macro-driven pullback.
So true.
So I'll leave you with this final thought to consider for your own models. When May 5th rolls around, will that upcoming earnings report deliver the explosive, undeniable growth needed to finally validate this 2.0x premium valuation? Or will the crushing weight of global macro fears finally break this stock's bullish momentum?